I think we're in such an interesting time period. I thought we were in an interesting time period like 4 years ago when you saw like InsurTech 1.0, like, oh, things are rapidly changing, but I'm seeing like another transition, much more interesting one of the types of problems that are being solved, how they're being solved. The word disruption was used a lot. You don't even hear it anymore. Like there's a general understanding of partnership. That kind of dynamic, I do think makes it much more interesting. I am Nick Lamparelli, and this is the future of insurance.
This episode is brought to you by Pinpoint Predictive, who provides P&C carriers with individualized intelligence to significantly enhance risk selection. Pinpoint scores leverage the latest advances in behavioral economics, enabling clients to boost key predictions at the time of quote, including things like claim frequency, SIU referral, litigation propensity, cancellation, and home inspection outcomes. Pinpoint's data enrichment and explainable analytics platform helps optimize front-end processes across marketing and distribution channels, including aggregators, agency book rules, MGAs, brokers, and direct. Pinpoint Predictive is backed by Stanford StartX, Jazz Ventures, and part of the InsurTech New York Accelerator. To see client endorsements and learn more, visit pinpoint.ai.
Nick, it's good to sit down with you and actually have a recorded conversation. We talk all the time.
We do. People wouldn't know, but we talk weekly. I have a feeling like our conversations are so fruitful, we should probably invite others in and kind of expand it out, but it will be like a very limited club.
I was gonna say fruity. I thought you might have been going there, but fruitful. There's certainly, like, we debate some stuff. There's no question.
We do. I think we generally are in agreement on most things.
Yeah, we don't debate each other. It's like there should be a third person on that we don't get along with.
Yeah,
because we tend to be arguing the same things. But it's good that we're finally recording this, because we've gotten into some meaty stuff about kind of where things are heading, and you've always got ideas. Like you start thinking about different ways we can do things differently. It's pretty cool.
I think we're in such an interesting time period. I thought we were in an interesting time period like 4 years ago when you saw like InsurTech 1.0, like, oh, things are rapidly changing, but I'm seeing like another transition, much more interesting one of the types of problems that are being solved, how they're being solved. I know we're going to probably get into InsurTech Connect, but the first set of InsurTech Connect conferences and other conferences around that time, the word disruption was used a lot.
Yeah.
You don't even hear it anymore. Like there's a general understanding of partnership, and that kind of dynamic, I do think makes it much more interesting. So that will make our conversation, I think, more interesting as well.
What is that? Is that the thing that you think differentiates the sort of like 4 years ago versus now? Is it disruption? So where it's like boxing robots, what are they, rock'em sock'em robots versus like
when the head pops off.
Yeah,
that one.
Like someone was trying to take the head off of the legacy or the startup, but now it's more about collaboration and partnership.
Completely. It's a 180-degree shift around those kinds of conversations. I think there was truly a belief that the industry itself was due for disruption, and that these tech companies were going to come in and do what they did to other industries. And it's just clear that's not going to be possible. Insurance has a different dynamic to it, different set of economic realities around it. And it is geared up more because it's risk transfer. Ultimately, it's really geared up to spread the risk. So it's really geared up towards having lots of parties involved. So the winner take all mentality that has sort of dominated technology, I don't think that exists in a pure form in insurance. I think there are cases here or there. I got to sit with Cambridge Mobile Telematics. I think they're in a particular position where they could have winner take all economics around their business.
Yeah.
But I think for the most part, insurance really thrives in a situation where people partner together to transfer the risk.
Yeah. Do they, so not to go on a whole sidetrack, but do they have that? Is that the outlook when you think about the connected car when it's coming from the OEM, or is it that CMT is the one who's doing the connected car solution for the OEMs?
Oh, I think it'll be both. I think there'll be some OEMs that are like, we got this. This is ours, our
Yeah.
technology. We're going to run this. And then there'll be others that will quickly see like, hey, why should we invest potentially billions of dollars to
Yeah.
have that technology, build that technology in the vehicles and keep it up to date as well. People forget that there's an ongoing cost.
Yeah.
When you have this tech company that already knows how to do it, they have the full infrastructure available to do it from a handset. And I just got a new Honda van that has, you know, the full integrated dashboard.
Yeah.
It's not keeping track of my driving, but it's got everything else. And it's not nearly as good as my phone. It's not nearly as fast as my phone.
Sure.
And I think the OEMs are going to struggle with keeping up with the technology.
Yeah.
Right. Like that's just another, like even companies like Tesla, I think that's just another area where you need a product manager to manage that over time, when you could potentially outsource that to the mobile phone. And now you don't have to worry about it. You just need to make sure that the mobile phone works in your car. So I think we'll see both, but I think in both cases, even in OEMs like Tesla that have gotten into insurance, for instance, they have an insurance partner. Tesla does not have nearly the balance sheet required or the expertise to be able to manage an insurance business.
Well, when you say the phone, you're talking about like UBI and you know, like charging you more when you drive faster or short, you know, stopping suddenly and all that kind of stuff.
Yeah.
Or doing a smarter version of it, you know, with more location awareness. But I'm talking about a connected car where there's data services in the, so like the OEMs are doing those things, and the data that comes out of them and the subscription for those services, like GM came out this week and they're expecting their revenue to double in, I think, the next 10 years, not even 10 years from now. And it's going to be driven by subscriptions, data services, and connected cars. So is it?
Yeah, I was thinking more UBI.
Yeah, no,
Sorry.
I mean, I'm thinking they're building out something bigger that then the UBI component is sort of like, oh yeah, we can do that too, because we know we know exactly where your windows were and what radio station you're on and the decibels and the wind on the outside and the temperature and they know all this stuff.
So to me, that's the interesting point I try to bring up in all of these conversations, Brian, is that in an old world of insurance, right, where we're working with claims experience, so it's an actuarial based model for us to do the necessary underwriting to manage the business.
Yeah,
that's changed.
Yeah,
like it's completely changed. Like take auto, right? Even before connected cars, we have UBI.
Yeah,
right. Which insurer would you rather be? An insurer that is using a traditional claims approach to be able to manage their business, or one that has a combination of claims and UBI?
Right.
To me, it's a no-brainer. I don't know
why wouldn't you want to know what the exposure is doing?
How would you not want to know? And how and wouldn't that give you a predictive advantage on risk selection?
Yeah.
Which means that in the old style world, if you're just using an actuarial model, you're going to be adversely selected. And I'm seeing that transition to property with sensors and other stuff.
Yeah.
So now you throw in connected cars, like the world around us is changing so rapidly. I think the insurance entities that are transferring the risk, they need to be on their toes and be able to keep up.
Yeah.
And they've been so far behind. They're just now making the sustainable effort to try to keep up.
Yeah.
But I think the insurance world is dramatically changing. The next 10 years from now, we'll look back and we will be functioning in a very different world.
Yeah.
I think we are moving towards more a combination of actuarial and pure data science in the execution of what we're doing.
Yeah.
So your example of connected cars just throws a wrinkle, like, oh, you're going to have auto insurers just getting comfortable with UBI, and whoops, UBI is irrelevant.
Right.
Or
that's already the last
relevant.
generation. Right.
You know, like it's changing that dramatically.
Yeah. I can't remember who it was this week. Carrier Management or PC360 or someone put out the top 10 auto insurers and their usage-based insurance, or pay per mile or what, and some of them have both, but they're different telematics coverage. And and by the way, CMT or True Motion, who they just acquired, I think like 8 out of the 10 of them, not just acquired, but not that long ago, something like 8 out of 10 or were their customers, and the ones who weren't, it was just like, will not disclose who they work with. So like they probably have 10 out of 10. But what was interesting is for several of them, they talked about the take rate. And I remember USAA was on the lower end at 25% of all new policies. And they're new to the game. So they're already at 25%. And then others were, State Farm, I think, was at 46%. So you're talking about like roughly half of new policies. And if we're talking about the top 10, it's half of 80% roughly of the market is opting for some usage-based or tracking, getting comfortable with sharing their data kind of solution. So you have 10 years from now, and there are plenty of large carriers who are still not even offering anything, not sure about it. We're thinking we might start considering the possibility of perhaps maybe, I'm like, all of these probabilistic terms in there. By the time you start your discussions for your POC, the world will have already moved. And then you've got, Nationwide last year and State Farm announced a partnership with Ford to get the connected car data. Verisk is doing things with that. LexisNexis is doing things with that. It just seems like the world's already starting the path of the next generation there.
Yeah. So it's when you and I have these discussions, it's, we can play games and try to predict out what's going to happen.
Yeah.
Like what the new technology will mean, or how do you get a competitive advantage? It seems clear as day what the competitive disadvantage is going to be, and that is doing nothing.
Yeah.
Like and someone I was talking to at ITC, I think said something to the effect of, it's worked for insurers over the last 100 years. Like it might have been even you, like this could have been the conversation we had last week. Could have been, you were safe. Like it was okay to be a fast follower in quotes.
This wasn't me, but keep going with it.
Okay. So it was okay. It was probably the safe position to be in, was let someone else take the risk. Let them kind of validate that a market exists or doesn't exist. And then we'll come in at some point once we see that it's actually working. So that was probably a prudent manner of doing underwriting, because, data science with big data is still in its infancy. Like we're talking, 20, 30 years. And so in an actuarial based way, any new product is super risky, because it's a leap of faith. That first launch, you're crossing your fingers and saying, we think we know, we're going to guess what the rate is, and kind of move forward. And then you slowly wait for those claims to come in to validate those things. So it's probably prudent for an insurer to kind of wait for someone else to jump in the pond. Right. I think that's over. Like you can't have that kind of business model paradigm. It will crush you now. You will be getting adversely selected. So your business is going to be, it's not like you're going to go out of business, but your business is going to be eroding underneath you. And you're not going to be sure why. Like you're going to think you're doing all of the right things, but it sounds like what will happen is what happened to insurers in commercial auto, where the rate increases and the changes in underwriting in arrears could not catch up to what was actually happening. And so every time they did a rate increase, it didn't matter. Like the claims were out ahead of them,
Right.
and it was just year after year of just being behind. And that's what's going to happen to auto insurers that aren't up to telematics.
Yeah.
And I'm going to see this. We're going to see the same thing in devices, sensors in property insurance.
Yeah.
Just amazing what these sensors are doing. I had a meeting today with a guy. I'm going to see if I can bring this up and show it to the great audience.
And for people who are just listening, we'll have to explain it, but
I don't know if
Nick's
how
showing
well
me a mobile phone that's very blurry.
Yeah, sorry.
Okay. Was it a dongle?
It's a picture of a sump pump.
Okay.
It's a smart sump pump. And so it has the day-to-day cycle history of the amount of water and the number of cycles the sump pump actually works. So this is for a home in Cape Cod.
Yeah.
And I would say on average, you're probably looking at about 100 gallons a day that this thing is, probably cycling through. September 2, 2021, 2,814 gallons were cycled through that sump pump to keep that basement dry, right? That was Ida that hit the Northeast. That's just a piece of the information that could have been collected around that.
Yeah.
Our ability to create smart homes is we're going to see the same transformation we saw from telematics in auto to smart sensors in general property. 10 years from now, we're going to be living in a different world.
Yeah. I had an interesting conversation with someone who's in the IoT for the home space. And one of the things they were saying is it's very hard to find sensors that tell you things early enough for you to do something about it. So for most sensors, once they're telling you something, the event has occurred. Like the water level rising in the house, or the glass breakage, or the burglar alarm going off, or the smoke detectors, fire alarm. A lot of those things are too proximate to the damage being so severe that you could have stepped in and mitigated it.
I don't know. The data from like Church Mutual.
Yeah.
So the largest writer of religious institutions in the US, and they're public. So this is all available on their website and their investor relations or shareholder relations. So I think they started their sensor program, especially, so they decided to put, churches are like 99% of the time empty. Yeah. So if something does happen, severity can be very high because there's no one there to do anything about it. Yeah. So they put temperature and water sensors in a select group of customers and have been expanding that. It's mostly in the northern latitudes where pipes freeze and stuff like that. The last annual report that I saw said that they've invested, this was a loss control initiative. Yeah. $14 million of sensors. I'm assuming that included installation costs as well. So 14 million to accomplish this. And so they actually keep track of saves where the sensor goes off and they're able to actually do something about it. And then they try to figure out what was saved, what was the end result. And their estimate is that, and that was also reported on Carrier Management just a couple of weeks ago, 3x return on the 14 million, 3x in savings, losses they would have paid had it not been for having the sensors in place. So, it's like a smoke detector in a way, like it can ring and someone still has to put the fire out. Right. And so the fire could go out of control. So there would be situations where you won't drive the loss cost down to zero, but I think you can make a meaningful dent.
You might cut the total losses so that it's salvageable.
Yeah. Or this is just phase one of where the sensors are going.
Right. And that's what I was thinking is it's early and it's sensors plus you look at like manufacturing control. So like flow by Moen, it doesn't just tell you that this is dripping. It also has the ability to shut the water off. So it's like, it's
here.
wasn't,
The technology is here.
Right. We got to start piecing it together.
The costs, it's just like PCs. The costs are going to go down.
Yeah.
Like if you're an insurer and you're like, oh, who's going to pay for this stuff? It's like, don't freaking worry about it. The costs are coming down.
Yeah.
It will continue to go down. 5G will accelerate that. So our ability to get more computing power into these devices, and our ability to communicate faster, like not just like a radio frequency device that can communicate to a tower and then to a police station or a fire station. We're now seeing the ability to use blockchain technologies where you can combine to a consortium where your device will connect to other devices in the neighborhood. Like you will get permission to connect. So the ability to make sure that even in catastrophic situations, the signal gets out and tells somebody, hey, something's happening here.
Right, it hops.
It hops. Right. But like I think the next generation of technology will just shut the water off. It'll detect something, notify people, no one responded. To be safe, we're shutting the water off.
Right.
Kind of thing.
A lot of people may not know how Apple's Find My network works, but it's not that your phone necessarily has to be on Wi-Fi or cellular or whatever. The network of all the Apple devices everywhere, they're using each other to create a meshed sense of where things are. And there's a lot of privacy in terms of who can see what's where. But that's where, like, you leave your keys somewhere and you're gone. That little air tag on it, it's using the fact that there's other Apple users, iPhone users, Apple Watch, whatever, and it's pinging on those devices back into Apple. So like, that's the sort of thing that you can start to enable when you open it up, and you can use things like blockchain.
So if you're an insurer, right? Like so I mean, I think we beat the auto piece of it to death, but I think of property. I think the framework has already been set. And if you're a property insurer and you're not getting in front of this, how can you possibly expect to get in front of it 5 years from now?
Right.
It's too late.
Right.
You're at the mercy of someone else. And this becomes part of my 10-year thesis when I think about the future of insurance, is that a lot of the carriers that are potentially listening to this are setting themselves up to be super commodity players. And they either need to decide we're going to, we want to be a leader, or at least have our finger on the pulse when it comes to the future of insurance in regards to technology. Or they're going to have to think about being a facilitator of insurance to other tech players and just playing that angle. We have a balance sheet, we have licenses, we have an operation, you can rent that from us.
Right.
I think both are okay, but there's no middle ground. If you think you're going to be competitive from an underwriting sense in your product going forward and going to be able to compete, forget it. It's not going to happen. The returns are going to come from one side or the other.
Right. And I hear, talking to some carriers, especially a lot of them are overcapitalized. And so what I hear is, we're fine. The market's not going away yet. We've got plenty of time to figure this out. And there's one carrier I was talking to in MedMal, the market's not in a good place. The commercial side of it's drying up because hospitals are buying each other and buying practitioners, and then they self-insure. So there's a smaller commercial market, and the whole thing's super unprofitable. I mean, you write in the 130s combined ratio, you're a rock star in that space. You might also still be profitable because the tail's like 12 years. But it's not a great space for a lot of strategic reasons. And their response was, oh, we have too much capacity. We've got too much surplus. Our state regulators are going to make us give it back. Or their answer is, we have so much reserves, we just keep releasing. It's fine. I'm like, but you're living off gas you put in the tank 9 years ago, 10 years ago. And of course it's coming out. But if you watch, every year is a little bit less gas going in the tank. And so eventually it's going to run out. And what you're saying is, well, until it gets there, we don't need to worry about it. But what happens then? AM Best downgrades you. And then, this block
you get a spiral of of
So like
things.
these
Yeah.
brokers won't work with you because your strength rating's not high enough, and these insureds in their bylaws can't work with you, and you're gone, and your access to capital is like today is when you think about it. And I think too many in the industry are thinking they have time to sort of figure it out and see what plays out. And and in the past, that would have been true. That's not really the paradigm of the change that we're seeing. Now, I want to hit on this because it was, there's a lot of discussion in the industry about Evan Greenberg's comments at ITC. And I know you were at the conference, but you weren't there for his talk. I'm looking at it for people who are watching the YouTube, and they're like, why is he like staring off into space? But like very provocatively and on net, just a way to talk up what Chubb has been doing. But it was sort of like the insurtechs are just hype, and it's the traditional carriers, that's who's really doing well, and we're the ones you should be betting on. And like, obviously, it's like when Michael Dell was poo-pooing Apple and was like, they should just give back all the money to their shareholders and shut the company down. Like, okay, well, should you really take Evan's word on what these new competitors are doing? Well, he also knows a lot, but he has a particular position on this issue. And Evan Greenberg as a CEO is not the same as a lot of other CEOs. And he gets into this, he talks about from push to shove. Like, he can shove people in the company to do what he wants. Not a lot of CEOs get away with that in the way that Evan Greenberg can. Not a lot of companies can do that in the way that Chubb can. So I think he's slightly a special case. But can we talk about this? Like, the insurtechs are just hype, and it's just the traditionals who we should be looking at.
I think for the most part, they have been hype.
Yeah.
I don't think he's wrong there. This is conversations we've had. Like,
yeah.
I was the author of Don't Believe the Hype, the lemonade story. I still think like they've done some interesting things, but they've done nothing significantly new, I don't think, and have not revolutionized the space. They are
or developed economics that support an ongoing business.
Yeah, they will at best produce mediocre results, right? So their ability to generate a return for investors 100% relies on market share, and so they're doing a lot to try to get market share, including bashing the industry. But that's not, I don't think that's bad. We bash the industry too. We just do it in a different way. So I think for the most part, it has been hype. I'm a fan of Hippo. Full disclosure, I'm a shareholder.
Yeah.
But they still suffer from a lot of the same type of issues that I think Lemonade suffers from. But at least there's, I think, an element there of, we don't want to be just an insurance company. We're this service thing to homeowners.
Yeah.
Right. And that's interesting to me because they have the warranty company.
Yeah.
Right. Which is, potentially sending people to do inspections or, to replace furnaces and stuff like that. That will show up in the loss costs.
Yeah.
But it's also really good interaction with the homeowner. The homeowner is going to think they're getting something more than just an insurance policy. And then the IoT thing is more of the same. I see Hippo moving in that direction.
Yeah.
That's part of the future of insurance.
Yeah.
As far as I see, but there are a lot fewer Hippos and a lot more Lemonades as far as I'm concerned. So I don't think Evan Greenberg's wrong. He does have a brash way.
Yeah. Which is probably intentional. Look, it's getting talked about.
Completely. He's a business expert. Like, he knows
just
if you're going to give me even bad publicity, just spell my name right.
Right. I think there's a lot of truth in what he's saying. And I think for a company of its scale and complexity, Chubb has been really innovative. And to Evan's credit, he put a significant amount of resource, and I don't just mean dollars, but people. I think when I had seen a number, which is a few years ago, it was roughly $1 billion in operating costs and 1,000 people globally, plus travel and investment in different pilots and whatnot into their innovation pipeline. And he took Sean Ringstead, who was the chief actuary at ACE, and put him in charge of it. And like, I've dealt with Sean before. Like, he's a smart guy. He's capable. He put real might behind their innovation efforts. So I think for their scale and complexity, they've done a good job. They've moved on things. They've tried things. They've invested. They were investors in CoverHound and lots of different businesses. But in the scale of how technology moves, they're still incredibly slow. They might be
still not fast enough.
Yeah. It was like,
amazing.
The joke making fun of insurance being boring. People are like, oh, it's really interesting for insurance, which means like boring for regular people. Well, like, they're really fast for an insurer of their size, but that doesn't mean they're fast.
Yeah, completely.
And I think whether he understands that or not, or thinks that's true or not, I can't say. But in his talk, he certainly doesn't seem to appreciate that they're still unacceptably slow when you think about what really could be happening. And if they were able to move that way, the way that he's claiming that they are, the transformation and the power that they could wield as a result of that is tremendous.
Yeah, well, let's separate Chubb from, like, they're the big entities, right? That I think just have so many resources and leverage in the market, the balance sheet, the assets, State Farm, things of that ilk.
Yeah.
We knew they weren't going to be disrupted. You can't disrupt the balance sheet like that. There were always going to be players in the game, and they are playing. Chubb, for instance, has I think the brand is, I wouldn't say tarnished, but it hasn't lived up to what it was when I was a broker. The Chubb brand meant a lot.
Yeah.
Like, they were the company that paid claims, even claims they weren't responsible for.
Yeah.
You were going to get the claim paid.
Yeah.
And they were very particular on who was a customer of theirs. So they pretty much were like the class act around private client and small to mid-sized commercial. Chubb was one of the elite companies around there. I don't think they carry that same prestige, but it's still a brand with, and I think they are, with the combination of ACE, I think they are the largest property casualty insurer in the world, I think.
In their, premium wise, they're like half the size of State Farm.
Commercial,
but maybe in their line, in commercial, they're if they're not the largest, they're top 3 probably, but they're pretty close to it.
So they're always going to be a player, right? But you're right. Like, I think he might be confusing insurance speed for real speed.
Yeah.
And for Chubb, I don't think it matters.
Right.
They're always going to be a player. If you're not anywhere close to that category, which is like thousands of insurance companies in the United States, almost all of the mutuals,
right?
The non-State Farms, I don't think Liberty's a mutual anymore.
Technically they are, but they don't. They operate like a stock company in a lot of ways.
Yeah. The farm bureaus, the regional carriers, you're not Chubb.
Yeah.
There's not a seat for you at the table if you're not going to move.
Yeah.
Right. Those are the ones where I think a lot of them are not doing anything. Right. But they're not even Chubb slow. Like, they're snail slow. They're like really slow. Those are the ones that I was kind of hinting at, that their businesses are going to erode underneath them. They'll still be in the game because they have something to offer, but they're going to be adversely selected. Like, Evan Greenberg knows the buttons that he's pushing. He's going to make a stink about it. He can, others can't.
Yeah. And to be fair, I look at other carriers that are similar scale and complexity and everything to Chubb, like Travelers and the Hartford. There's plenty of others that have, similar kinds of business
Yeah.
that are not doing what Chubb's doing, and they're not doing it as effectively or quickly or whatever. But it's like it always. I think I've used this on the show before. Like, it reminds me of my bank robbery example, where it's like, if I robbed 10 banks last year and 5 this year, I'm better, but that doesn't mean I'm good. I'm still a bank robber. Like, well, yeah, you're faster, but or you're achieving more, but that still doesn't mean you're doing what you could do. And I agree. For Chubb, it's probably not relevant. Like, they're not going to go anywhere. They're still going to do a
Yeah.
hell of a lot. They're going to dent the market. Like, it'll
And to
still
your
work out
point,
for them.
about influence, I at one of those bigwig conferences, I saw Evan Greenberg walking with Bill Gates,
Yeah.
talking about climate change,
Yeah.
right? So the influence that Chubb could have is immense
Yeah.
here,
Yeah.
but they will move very slowly
Yeah.
on it. But I would separate Chubb from everyone else. But listen, there's a lot of hype,
There is. Yeah.
And from our conversations, let's make everybody else privy to them.
Uh-oh.
It's we talk about a lot of this, and the future of insurance, when you think about like startups who are coming into this space, if you have to raise capital, raise capacity, create your technology, and run a business, that's just too big of a mountain to climb.
Yeah.
And so a lot of companies have gotten through, but I think a lot of it is with smoke and mirrors and hype. And I'm hoping companies like Chubb can be a little bit more innovative to nurture and protect the startups that are coming in, so they don't have to go over all 4 speed bumps.
Right.
They can eliminate some of those speed bumps and get some of that technology, some of that innovation into the system faster.
Yeah. Nick, I want to be conscious of time, but I'm reminded of, it might have been the second episode of the show. It was either second or third. John Grogan, who's the chief insurance officer at Northwestern Mutual. I only know his side of the story, so I don't know whether any of the startups that he's referring to would say this about their relationship or not. But he's talking about the investments that they've made in a number of life tech, or life insure tech kind of companies. Some solution providers, but some what's one you had them on the Coverager podcast, Day Forward.
Oh, Day Forward. Yeah.
Day Forward. Yeah.
Yeah.
So Northwestern invests in them. And so, he's talking about these investments, and he's like, yes, financially they've worked out really well, but actually it's what we're learning from them. It's what we're getting by working together. And that's the part, like, I don't know whether startups would say like, oh yeah, Northwestern's been such a great partner. Like, maybe I just haven't heard their side of it. So I can't speak to whether what John's saying is 100% mutually felt or not, but his take on it, I thought, was so refreshing, that like, it's not just money, and it's not just about using the vendor. It's about, how can we grow together? How can we look at what you're doing and why you're doing it and how you're thinking about it? And can we bring any of that mindset, any of those solutions into how we're trying to, slice things on our side and learn and grow? And there's, I think John's fantastic, but he had this great kind of optimism and outlook about that. To your opening point about what's different with InsurTech today, it was more like, what can we do together? Instead of like, oh yeah, we invested so we can see and then squash them. And he's not going to say that on the podcast, but like, that's not what they're doing. It's not acqui-hire, and it's not just buy them out and then don't deal, so we don't have to deal with the noise. It was genuinely like, that's some really interesting stuff. And that's what he said, is like, some of these guys have done things that if we weren't at the table as an investor, we wouldn't have seen it, and we wouldn't have been able to bring that mindset to bear when COVID hit. And suddenly, you're not meeting in person with your financial advisor or your agent or your whatever. And our whole business would have ground to a halt if we hadn't been introduced to those other ways of thinking about things.
Yeah. And that's been my experience working with the incumbents in the space. I'll give kudos to like Swiss Re and Munich Re, who are partners of my MGA, and they both said the same thing. It was, it's very important for us to learn from you.
Yeah.
You're the boots on the ground. This is an area that we can't get transparent access to. around what's happening in, in some ways, for flood, they were taking a leap of faith. So this is 4.5 years ago. The private market's nowhere like what it is today.
Yeah.
So to them, it was like a leap of faith. Their hypothesis was, this is insurable. So let's back some companies that can teach us, whether it is or not. And if it is, how?
Yeah.
Like what's the more optimal way to do that? And I think we've been successful doing that. With that said, our approach coming into the market, it still takes about 2 years to get an MGA off the ground.
Yeah.
So the same raise capacity, raise capital, raise capacity, build your technology, run a business, is the wind up is way too long for these startups. These startups are just too fragile to have to go through that. So some of the conversation that you and I have had was around linking the capital and the capacity. Now, insurers talk a good game and just say, we'll do both. But I'm going a little bit nuanced, a little bit deeper in that once they've been vetted for one, they should be vetted for the other.
Yeah.
Not you vet for one, now let us bring you into the family and have someone else vet you for something else.
Right.
That can kill a company. That's smothering.
And there's a few
good intentions, but it's smothering.
Yeah. Well, I think about like Adrian Jones at well, he used to be at Score, and I was gonna say Score as well, but with HCSM,
Hudson
HSCM. I always get the letters mixed up. So Hudson Structured. That's the model that they're trying to take, is like, will be investment and capacity, and that's a single evaluation, because we're trying to see, is this business a business we want to support? And there's multiple ways we can do that, and it's and Score has a history of doing that too, and there's a few others, but that's absent that, to make each of those like, and you didn't even talk about when you say capacity. I think you're simplifying it, because if you're an MGA, capacity means reinsurer and fronting carrier. Maybe you get both in one shot, maybe not. But there's a few in my book that like 2 separate discussions, and both of them in different stories were going to kill the deal. Like Clearcover, the fronting carrier pulled out and like almost tanked the whole thing. And so they had the investors were going to drop and the reinsurers going to drop.
There are too many cogs, right? And if one thing goes wrong, it ruins everything.
3 capital cogs at worst.
And that's where like, so companies like Chubb, not to leave them and like the influence they could have. Like they can bring capacity, capital, lots of resources in the back office and other things. So I've seen companies do like innovation labs, and they're almost jokes in what it is that they're trying to do. Like the startup and these innovations are so fragile that they need a champion who has some degree of authority around all of those pieces and can nurture it to a degree where when it finally does get exposure to the rest of the family, it's not going to get smothered. So it's really like truly like an evolutionary thing of protecting this thing and not allowing siblings or other predators from getting its hands on it. And even with the best of intentions, once they get their hands on it, they smother it and suffocate it from
they bring it down
the
to
oxygen that they need.
I think it's a really interesting one outwardly, but then also if you get it right, that model can be used internally. So I can think of a few cases where a traditional carrier who has all these great resources and gets all the tough stuff that Evan Greenberg's talking about, and I talked about in my first book, like the risk transfer and the capital management and all, like that's really, really hard stuff. What if you brought those resources to bear without the constraints and you did a startup? So it doesn't have to be somewhere outside. I'm thinking like Mobilitas at CSAA. There's an example up in Canada with the cooperators where they have this little unit that they can play and they have access to all of those resources, but they also have the freedom, and they're not judged in the same way that the mature businesses are. So, the C-suite is actually, and a member of the C-suite was actually assigned ownership of it. So they get air cover if they need it, but they can have mediocre results or whatever while they're developing and playing, because a young book is probably not going to perform well for a while until it reaches maturity.
Yeah.
You need to be free of a lot of those things to get where you're going. So there's interesting stuff brewing in a few places.
Yeah. The current business model, right? And I think I'm thinking more of the culture of the business model, where we have like actuarial departments and claims departments and underwriting departments.
Yeah.
That old school culture is not going to work.
Right. Yeah.
I can guarantee you it's not going to work. And so from everything that we talked about at the very beginning, which is in a world where with telematics and connected cars and now on property, sensors that are going to have dramatic effects on loss costs, the actuarial old style culture is not going to suffice.
Yeah.
So you have two reasons why. One is like your current business model, just to keep it fresh, needs a transfusion to be able to do that. And so, but now you have this other thing where if you can successfully do that, you have the ability to incorporate new technologies, but also build your own inside and spin those out as well. Like that sort of business model dramatically changes who you are and what you can do.
Yeah.
The old school model really is going to be stuck in a corner, really challenging environment with, I think, economic value eroding underneath them, because they're just not going to have they're going to be burning resources just to stay alive. And that's unfortunate, when those resources could be brought to bear in doing some stuff that's interesting.
Yeah. Nick, I think that's where we should wrap things up, because there's no end for our conversations.
No,
we could keep going. Usually I just say thank you, end with a guest, and then I do the closing separately, but you're like family. I could just keep you around. But this is fun, and it's good to finally like record this and share. Like, this is how we spend our Friday afternoons. I don't know what people watching or listening do, but like, you could be doing this. Find someone, and I mean that actually in all seriousness, like find someone interesting who you can talk about what's really going on and engage with them. That can help our industry as well with thinking through some of this stuff instead of just giving into the same old.
Yeah. I mean, at first it was just like two friends kind of chewing the fat.
Yeah.
And now it's like, I really feel like I got someone I can bounce ideas off of. I hope you feel the same way, but
absolutely.
Like, you're like, a lot of the things that we talk about and have very much influenced my thinking, and in some ways like 180 degree thinking. Like, I was thinking of it in a certain way, and you bring like certain data points or certain stories, the books that you're reading, the conversations that you're having, you bring those to my attention, and it helps me be able to defend my ideas. Because in some ways I'll have hypotheses and they're based not on the foundation I think they're based on. You bring a new data element to it, it's like, oh, I should rethink this. So
we should talk through it. And that's why people can't see, but I got my Nick list. I just like scrap of paper, and I just all week I'm like, and then sometimes we don't get to talk, and so I end up generally losing the list and starting another one the following week. But part of the stuff is it's moving, so it's a fluid conversation. And we probably both go in thinking like, oh, maybe we skip this week, and then we go like an hour and a half for our 30-minute catch up.
Oh, that happened like last week.
Yeah.
Where it was just like, no, like should we have it? And I think I was late for
really have
meeting.
anything. No, we don't.
And then I was just like, I could use 5 or 10 minutes of your time. Next thing you know, 45 minutes later, we were still chatting, and we both like, oh, we got to get off. Like we have other calls we have to jump on, but they're that fruitful.
Well, I do appreciate the time with you. It does a tremendous amount for me. And I think everyone you should all have a Nick in your life, but you can't have this one because I already got him. Nick, I want to thank you for the time. And I also want to thank the team at Pinpoint Predictive, who is the sponsor of this episode. When we talk about a different way to look at risk and we talk about where the industry's going, there's there's a lot that they're doing that's just very, very interesting. And I met them at it was the last in-person event I did before lockdown. It was an SVIA event, and I was on a panel with Avi, the founder, and like bad panel etiquette, I turned in my seat and just while Avi was talking, like I ignored the audience, and I was just like, for people who are listening, like my mouth was agape. I'm listening to it and I'm like, oh, you could do this with this, and you could think about this, and like, oh, well, what about in claims? And so it's been very cool to dig into what they do. And it's all about this, like, how do we relook at what the behaviors are of the exposure, and what can we do with that at the prospect, at quote, at, you know, once they're an insured, or maybe it's a third party and it's a claim. There's so many interesting things we can do. So big thank you to Pinpoint. I don't read ad copy in the close, but I kind of ended up, I mean, I was winging it, but I ended up saying more than just thank you to Pinpoint, but thank you to Pinpoint, and to Upbeat Music for the music for the episode. Nick, thank you again for joining me, man.
You're welcome. And I'll see you next week.
Yes, sir. But they won't see us.
Yeah.
Yeah.
It's private.
It's private. Thanks, Nick.
Okay, man.